Hi all, welcome to the channel Foundations of Real Estate Financial Modeling. Today we'll talk over a very important concept called expected return, how we use it in portfolio theory, how to calculate it, what it is. We'll take a look at the formula and we'll close it off with a sample problem. So what are expected returns? So expected returns are essentially the profit or loss that an investor anticipates to make on an investment. This is calculated by multiplying the potential outcomes by the probabilities of them occurring. And in a portfolio where you contain multiple investments, multiple assets, the return on the portfolio is just the expected return of each invested, weighted for the amount of money that was invested. And that'll make more sense when we get to our sample problem. So the formula, here you can see the formula. So this is expected return equals to the sum of the products of the probability happening for a specific return. So if you have two expected outcomes, you have two probabilities, two returns, you add those up, that's the expected return. Okay. So let's go into our sample problem to illustrate how we apply the theory that we just talked about. So let's go and take a look at a fictional world. So fictitious world, we have a portfolio in an economy. So let's take a look first. Let's consider the economy first. So status of economy. So we say that you can either have a boom in the economy, or we can have a bust. It can crash. And then let's say that we know that the probability of each of these happening is 50%. So we have 50%, 50%. Say that we have a portfolio where we own a multifamily building. So return multifamily. So say we know or we think that the multifamily property is gonna get a 10% return if the economy does really well, if it booms. And if the economy doesn't do well, we think we'll make a 5% return. Say we also have an industrial property in the portfolio. And let's say that we think that the industrial property is gonna provide a 20% return if the economy does well, and a 10% return if it doesn't do too well. Now, let's also consider the weights of money that we invested in each of these properties. Okay, so because we think that the industrial property can do relatively better than the multifamily property, as we can see on the probabilities and the returns. Let's say that we invest 70% of our money on the industrial property. So that's the weight invested in industrial. And let's just say that we invest 30% of our money in the multifamily property, okay? So in order to calculate the expected return on the portfolio, we first need to calculate the expected returns on each of the individual investments within the portfolio. So let's take a look at the expected return for our multifamily property. So expected return for multifamily equals to 0.5, which is the probability of a boom, times the return of the boom, plus the chance of a bust, which is 50%, or 0.5, times the return on the bust. So this is going to be 0.05 plus 0.025, and we add these up. This is 0.075, or 7.5%. Now we need to calculate the return of our industrial property in each of the two scenarios. So the expected return industrial equals to the probability of the economy having a boom and the return of the boom, plus the probability of the economy having a crash, times the return during that crash. So that is simply 0.10 plus 0.05, and we get a return of 0.15, or 15%. If you're wondering how we're getting from 0.15 to 15%, it's just times 100 and you get the 15%. Same here, times 100 and you get the 7.5%. Okay, so now we have the individual expected returns of the assets in our portfolio. Okay, now let's take a look at what the expected return of the portfolio would be, giving us investing that 70-30 split on each of the assets that we have. So the expected return on the portfolio equals to the amount of money we invested in multifamily. So say we invested 30%, times the expected return of the multifamily investment, plus the amount of money we invested in industrial, times the expected return on industrial. Now you gotta multiply these out. It's gonna be 0.0225 plus 0.105. And this gives you a return of 0.1275, or if you want to multiply by 100 to get a percentage, 12.75%. And that's it. That's how you use this expected return for individual investments, individual assets, and how you use it collectively for a portfolio. So that is it, guys. In the next couple of videos, we'll talk about Sharpe ratios. We'll delve a little bit more into expected returns. We'll incorporate the variance, the standard deviations that we saw in the previous videos, and we'll go over how to create that market portfolio, that most efficient portfolio that minimizes your risk, giving you the most return. So stay tuned for those videos, and I'll see you guys next time.